Today, we're looking at large cap companies in the USA. We are looking for high growth, both in the future and historically in the past 5 years. We are looking for low debt, under 0.7 debt to equity ratio. And what we're going to do is we're going to apply our inner flame finance scoring method to these companies, and we're going to compute intrinsic value. And it turns out of these 21 different companies that we've boiled it down to, only 2 stand out as high growth, high quality, and a bargain value today. Now I'm just going to get right to it. If you get anything out of this video, please like this video, subscribe to the channel, keep coming back for more. I'm just going to show you all the growth scores that I pulled for these companies here. You can see that they all have low debt to equity, under 0.7. You can see phenomenal PEG ratios. All these PEG ratios are 2 or under, except for CR. Forward PE looks solid. 5-year forward PE looks great. And we see some of the big dogs in the stock market. We see Netflix. We see Micron, which for us personally, we tripled our money in Micron in the year 2025. We have Microsoft. We have Google. We have Amazon. And so out of these 18 companies, we're going to boil it down to 2. But first, what I want to do is I want to show you the growth scores. Remember, on this channel, what we do is we score companies between -10 and +10 based on growth and safety. Today, we are only going to focus on growth because none of these are safety plays. There are not reliable, hefty dividends being paid. These are still growth companies. But what we do is we apply our scoring method, and we get scores between -10 and +10. -10 is absolute garbage. +10 is the best company in the world. 0 is neutral. And because we want to be picky and choosy with where we invest our money, we only consider companies that are 5 or higher. And so what I have here are a bunch of companies like Amcor, STLD, NUE, CEG, coming in under 5. Amazon is a 4. In the past, we've made exceptions for Amazon, but today I really want to focus on strong growth companies. Amazon is a strong growth company, but their numbers aren't reflecting that yet. And so they're still coming in at a 4, and we are going to throw them away. As a matter of fact, we're going to throw all these companies away. So the only companies that we're going to compute intrinsic values for are CRS, CR, we got Netflix, we got Google, APH, Royal Gold, Microsoft, ANET, NVDA, NBIX, and Micron Technology. So here we have companies that score a 5 or higher in our inner flame scoring method. So what we're going to do is we're going to apply intrinsic value calculators to all of the companies that score 5 or higher. Now, if you're new to this channel, welcome. What we do is we apply intrinsic value calculators to the companies that we want to analyze. If you want to build out your own intrinsic value calculators like I have here, there are links in the description of this video where I show you step-by-step how to do that. And there are 4 basic ones. There's the PE ratios model. There's the dividend discount model. As a matter of fact, none of the companies that we're going to look at today are going to do dividend discount models because they are not reliable, hefty dividend payers. We have the discounted cash flow model. This is one of the most standard, most well-recognized intrinsic value calculators. And then we have the Peter Lynch multiples model. Not always appropriate, but for high growth companies like we have today, we are going to use Peter Lynch on some of these. So you can see that we've done that for Micron here. And PE multiples model comes in at 863. Dividend discount model we're skipping because the dividend isn't high enough. Intrinsic value of MU, according to the discounted cash flow, is 293. Peter Lynch says that Micron is worth 370. So what we do is we average all those intrinsic values together, and we get the intrinsic value average, and that's what we're going to assume that Micron should be trading for. So that's what intrinsic value gives you. The price is currently $340 at the time of recording this video. Intrinsically, we think that Micron is worth $508, and so that gives us a 33.2% margin of safety for Micron. And so we're going to do that for all 18 companies that we saw, minus the ones that came in with scores of 5 or lower than 5 on the growth score, and we're going to show you those results in a bit. So, like I said, only 2 companies are going to fit the bill. They're going to have good growth scores, and they're going to have a high intrinsic value, meaning a decent margin of safety. So drop a comment down in the comment section to see if you can predict what these 2 companies are before I reveal them. As you're doing that, I also want to point out that this sheet looks a little bit different than you may be used to if you follow this channel. I have buy heavy and I have buy. What that means is if we have a good growth score, meaning we have conviction in our growth companies today, and we also have a decent intrinsic value, meaning that the company is more valuable than the market is currently setting the price at, then we're going to buy heavy if we're getting a 35% discount or more. All right, so if it's 35%, 40%, 50% discount, we're going to buy heavy, okay? And what I mean by buy heavy really just means whatever you want it to mean. For instance, if we were going to put $100 into a company and it comes in at a buy heavy signal, then maybe we would buy at $150 or $200 worth of that company, whatever. Okay. It just means that if we have conviction in this company, if we have a good growth score, and it's at a cheap valuation, then we want more of that because it's cheap, it's on sale. Okay. And then I have the buy price. And so that just means until a 15% discount, we're going to buy just regular. So if we were going to put $100 into it, we're still just going to put $100 into it. Okay. So without further ado, let's check out the first company. The first company is Micron. Probably no big surprise there. They have a growth score of 8. The intrinsic value is $508. They're currently trading for $340. That gives us a 33.2% margin of safety. And so any price under $330, we are going to buy heavy at Interflame Finance. Okay, so what that means is if we see any price in the near term below $330, we're going to buy a little bit more than we were going to. If we were going to invest $100, maybe we're going to do 120, 130, 150, just to get more of that company while it's at a good growth score and it's at a cheap valuation. And then basically, we're going to buy Micron in the near future for any price under $432. So as long as it's $432 or below, we're going to buy Micron. Second company is also probably not a big surprise, NVDA. Currently trading for $189. Intrinsically, it's $311. That gives us a 39.2% margin of safety. And so this does fit the bill for buying heavy right now. The price is $189. That is under $202. And so we are going to buy heavy for NVIDIA. And so if we were going to buy $500 worth of NVIDIA, well, maybe we're going to do 600, or maybe we'll do 750 or something like that, because it's at such a low intrinsic value, or I'm sorry, it's at such a large margin of safety at a low price relative to its intrinsic value. And we're going to keep buying NVIDIA until it hits a price of $264. That would give us a 15% or greater discount on the intrinsic value of $311. So there you have it, folks. If you got anything out of this video, please like and subscribe. Tell your friends, tell your family, tell your mother-in-law. We're building out the Interflame Finance family and community. We enjoy making these videos. We enjoy having these conversations with you, showing you our methodology. We want to hear from you, so drop a comment down in the comment section below. And please remember that nothing that we say on this channel is financial advice. I am not a financial advisor. I'm not a certified financial planner. We're not telling you to buy, hold, or sell anything in this video. So please always do your own research and due diligence. Thank you for your time. Thanks for joining us, and we'll see you in the next video.